Hey everyone, welcome back to my little cannabis series, and we're looking at tier 1 MSOs, multi-state operators, and today we're looking at Cresco Labs. And we're going to go through my tier list at the moment and we'll rank them at the end to see where they fit amongst the others. So they're sitting at about $1 billion enterprise value at the moment, and a common thread that you've seen throughout the series so far is that growth rates have slowed right down in the space. Consolidation is happening, numbers are down. A lot of the hype that was in this market back in COVID times has really come out. The whole industry was growing at like 100, 200% per annum there for 3 or 4 years from 2018 to say 2021. And then it's now flatlined since then, if not declined a little bit. And the entire market has freaked out and just crashed. And it's been really interesting to follow along. All the cannabis businesses are realizing now that capital is very difficult to get their hands on, and they've got to tighten up their belts of all their loose operations that they were running and all the M&A activity that was going on. It was crazy, and they better get profitable very fast because they're going to run into trouble. Now, to access a company like Cresco Labs or any of the other MSOs, which by the end of this video, you're going to see that I probably don't recommend, but if you are interested, you're going to need a broker that can give you OTC access, over-the-counter markets, which is where the cannabis stocks reside. And Interactive Brokers is the one that I use personally. I have an account with them. That's how I've done my purchases of cannabis-related stocks and most of the other companies that I've invested in as well. So Interactive Brokers, I have demo videos here in my channel, link in the description below. Cresco Labs. Now, they're just another of the consumer cannabis retail businesses, but they also produce cannabis for the wholesale market as well. So there's a slight difference there. I would still call them an MSO though. They are a retailer with some potential tailwinds coming, just like all the other MSOs with safe banking. All my other videos, I explain what these things are, but safe banking laws could be changed at any moment. Legalization across different states can be changed at any moment. Eventual federal legalization, and then in particular the tax breaks with 280E and having that removed will make a huge difference to all these businesses, because at the moment they're getting taxed on their gross profit, not their net profit, which means all their expenses they're not getting written off, which is a big disadvantage compared to all the other businesses that are not federally illegal. All these businesses will make a lot of cash. Even if any of these things change, the fortunes of these businesses will change quite dramatically. But we want to only invest in companies that are going to make it, because we don't know how long this will take. Maybe this takes 1 year. Maybe it's going to happen in the next week. I don't know, but maybe it takes 10 years. We really don't know. So we really got to still look at the fundamentals of these businesses and compare them amongst each other to see who is better run and not as well run, because we're just lowering the chances of us losing money if we do invest in these companies. Now, Cresco will have quite a larger footprint as soon as they acquire Columbus Care, which was announced about 12 months ago now. They're sort of going down the land grab approach. So as you can see, Cresco Labs have about 64 locations in 7 states, but Columbia Care have 85 stores in 16 states, and they're going to combine forces to be one of the biggest. They're going to be right up there with Curaleaf in terms of size. Regarding their footprint, with Cresco Labs and Columbia Care combining, they don't really have a strong foothold anywhere in particular, not like how TrueLeaf, for example, has a huge presence in Florida and smaller presences in the other places. They're not really dominant anywhere in particular. So they're just going to be a larger footprint, but not as dominant anywhere still. That's how I read this. Now, Columbia Care is still listed and they have an enterprise value of about $700 million right now, but the deal was for $2 billion about a year ago. This is quite a big acquisition, further consolidation in the space. It's a pretty bold move. Cresco Labs already are sitting on a lot of debt, and they're going to dilute shareholders to acquire Columbia Care, which makes sense. It's very similar to what happened with the TrueLeaf Harvest Health acquisition. As TrueLeaf are finding out, this can take years to integrate the two units together. All their numbers have been reduced, their margins, their costs, everything like that have really taken a bit of a hit trying to integrate these two businesses together, and it hasn't paid off yet. It might in the future, but it's a difficult 18-24 month period coming up for both Cresco and Columbia Care to try to get optimizations here involved, and I don't feel comfortable that they're going to be able to pull it off anyway. Like I said, they already have a lot of debt. There's a lot of intangibles on their balance sheet already. I think this could end quite badly if the market stays tough for an extended period of time. I think writing down those intangibles, like they're already probably going to have to write, if it's going to cost $2 billion to buy Columbia Care and now the enterprise value is only $700 million, that is a huge write down if they were to put this at market value on their balance sheet. That's a $2 billion to $700 million. That's a $1.3 billion write off essentially. That's serious destruction of capital. Hindsight is a wonderful thing. Stock prices have just come down to make that situation happen, but I think they've overpaid. I think Trulieve overpaid as well, but these guys are looking like they're going to seriously overpay. And I think that leads me to what I really want to discuss to summarize all of these MSOs that have large intangibles and what an impairment charge actually means. See, what happens is that a business goes out and acquires like the $2 billion worth of licenses and stores. Say that's $20 million per store on average, and then $400 million extra for the licenses for the specific states. Now, when competition erodes the margins of these stores and you don't have a real competitive advantage, some of the stores may be making $1 million a year, maybe some of them are making $500K a year, maybe some of them are making a loss, maybe some of them are making $3 million a year. In 5 years' time, as market cycles change and the rules change and those catalysts kind of come to fruition, some of these stores that they paid $20 million for, well, they're possibly only going to be worth like $1 million, maybe less. Maybe they have to just write them off as a complete like write-off. As the business realizes that the chance of getting the $20 million back is getting more unlikely, they're going to have to adjust for this and write down their intangibles, and that's an expense. Equity will also go down, and this is how the business destroys capital. And as investors, we are trying to grow our capital and invest in things that end up far more valuable than what we pay for them. Unfortunately, companies mess this up all the time. And why? Well, essentially what happens is, just like all investors, the thesis changes on them. Because, for example, initially they were told that there might only be, say, 5 licenses going to be issued in a particular state. Then the state changes their mind and just say, we'll issue as many licenses as anyone wants. And that just erodes the competitive advantage that those stores had originally because the rules changed on them. And it makes things really hard to predict and really hard to account for. Therefore, acquisitions in this space are really tricky, and I don't want to be paying too much for stores and licenses. Some people disagree with me on this and think that you should be paying big to get the licenses because it gives you this protective moat around your business to essentially print money. I just think rules can change. Cresco Labs have recorded impairment losses already, which is essentially them admitting that they've overpaid. In late 2021, they booked almost $300 million in impairment losses. They still have $700 million of intangibles, which is more than their entire equity of the business. My guess is that these intangibles are worth maybe half that or more than half that they're carrying it on the books at the moment. Therefore, I think impairment write-offs are going to continue, and that's going to destroy more value for the shareholders. Cresco have admitted and made a $300 million mistake, and I think that's not the end of it. I think that's a pretty big red flag. I think that's enough of a red flag for this. But comparing that to the other companies I looked at previously, Verano have $1.4 billion of intangibles. That's similar to their equity value as well. Trulieve have $1.8 billion of intangibles. That's also similar to their equity value. Green Thumb have $1.1 billion of intangibles compared to, they have a bigger equity number of $1.7 billion of equity. Curaleaf have actually $1.8 billion of intangibles compared to just $1.3 billion of equity, making them the worst by far. Honestly, this is pretty ugly, but it could cycle through. What I mean is, if that 280E reform and legalization reform actually start to come through, then these valuations might actually be okay. So I think as long as they don't get themselves into any sort of financial distress and don't have to sell any assets, then time might work out for these intangibles. They might actually be as valuable as they say they are, but they might not if licenses are not enforced and other rule changes are made. Essentially, you want a company without too much goodwill and intangibles on their balance sheet. Maybe 25% of intangibles to their total assets ratio would be okay. That's sort of what I look for. But when intangibles make up all of the equity of the business, well, that for me, I think is now considered a very high risk play. And Cresco Labs, well, they've made many acquisitions, and yet I don't see anything that makes them unique. If it's just about licenses and store locations, I don't think that's going to cut it. Again, this could be a nice business, but no reason that the other MSOs just won't compete away their margins. And yeah, I don't see anything interesting here. And regarding their crude metrics, we've got 43% gross margin, only 2% operating margin. That's poor. So they're making a loss at the moment. Market cap sitting at a bit over $500 million. Price to sales at 0.6, which is pretty low, but like I said, the intangibles and stuff like that make this thing pretty ugly. Enterprise value to EBITDA, 22x and 10x respectively. Nothing makes them unique. Debt to equity at 1.19, which is the highest of all the MSOs, which I don't like. Debt to EBITDA 5.6, which is also the highest. So they're already highly levered. Cost of capital is going to get really difficult. This is ugly. I don't like Cresco Labs here at all. And if they do make this big acquisition, they're going to be running at a loss for a while yet. So they've got stock-based comp, they've got high salaries of their C-suite, but also low insider ownership, which means there's not that much skin in the game here from the CEO and people like that in the C-suite. I don't like Cresco Labs here at all. So my overall summary probably looks something like this. They've had impairments in the past. A massive deal for $2 billion is on the table that looks way overvalued. They've got poor operating margins. They've got no competitive advantage. They've got high levels of debt, no significant insider ownership. And after all of this, I still wouldn't be surprised if the stock actually performs really well. As the cycle turns, money will eventually just flood into this space. There are just too many catalysts that are tailwinds for Cresco Labs, and the rising tide, I think, is going to lift all the ships, Cresco included, if they're still around and when the tide actually starts to rise. Cannabis investors, I don't think, are the smartest group of people. When money comes in, like we've seen with like ARK investment funds and crypto and meme stocks and things like that, hype and Mr. Market can get euphoric. And being one of the biggest names in the space, people are just going to put money in blindly, I think. They're going to put it in basket bets into all the MSOs or into cannabis-related ETFs, which are just going to buy all the big MSOs, these tier ones. Now, this is definitely not for me because if the catalyst don't happen, I don't see a bright future for this business. I'm working towards finding a business that doesn't need the catalyst to do well, and the catalysts and then just like upside that propel it further. Essentially, I'm just trying to minimize my chances of losing money, and the upside I think will be strong if in any of the reasonable cannabis plays, if they can get that far. So now let's turn to my tier list and see where they fit compared to the other tier 1 MSOs. Okay, so compared to the other MSOs, I'm going to put Cresco at the bottom. They're not in the E tier, mostly because I still can see a scenario where this stock does actually really well with all those catalysts just coming through, but everything is suggesting that this is a poorly run business. I don't like their situation from all their financial metrics. I don't like how this is set up. There's too many negatives on this one compared to Curaleaf. Cresco Labs wouldn't be touching. Verano, Green Thumb, Trueleaf are better, but not great either. That's where they're sitting at the tier list at the moment. I'm going to add some more companies to my cannabis tier list here in the future, but this is where the big MSOs sit at the moment in my eyes, and I would be very interested to hear what everyone else thinks. Do I have this tier list correct? Would you be changing this up in any way? Yeah, tell me what you think in the comments below. I will thoroughly enjoy reading them, and I will see you in the next video.